We are currently witnessing a massive divergence in the derivatives market that the vast majority of retail traders are completely ignoring. While the price of Bitcoin has successfully reclaimed the $78,000 level, the underlying order book depth is thinning out at a truly alarming rate. If you are currently holding Bitcoin with the belief that this is a guaranteed straight shot to new all-time highs, you are exposing yourself to significant danger. The reality is that smart money is quietly positioning itself for a volatility event that has the potential to wipe out leveraged positions on both sides of the market. You need to understand whether this price action represents a genuine flight to safety or a sophisticated liquidity exit trap set by the largest whales in the ecosystem. Over the next 8 minutes, I am going to deconstruct the on-chain metrics and macroeconomic signals that prove exactly what is happening behind the scenes. We will look at the specific data points that separate the institutional investors from the retail crowd who are about to get caught off guard. Let us get into the weeds of what is actually driving this price recovery to $78,000. The move we are seeing is not just a simple recovery from a local bottom or a technical bounce. It represents a critical testing ground for the safe haven narrative that institutions have been pushing aggressively for the last 18 months. However, when we look at the spot cumulative volume delta, we see a major discrepancy that concerns me. The price is moving upward, but the volume supporting that move is declining on the major spot exchanges. This indicates that the rally is being driven largely by speculation in the futures market rather than organic demand. When the price rises on low volume, it suggests that the sellers are simply exhausted, not that the buyers are aggressive. This creates a fragile market structure that can collapse rapidly if a large sell order hits the books. We need to talk about the definition of a safe haven asset in the current economic climate. Traditionally, investors flock to gold and government bonds when they fear economic instability. Bitcoin is currently attempting to cement its status as digital gold, but the correlation data tells a complicated story. For the first time in 6 months, the correlation between Bitcoin and the technology stock sector is beginning to weaken. At the same time, the correlation between Bitcoin and gold is reaching levels we have not seen since late 2020. This suggests that a specific cohort of investors is treating Bitcoin as a hedge against monetary debasement. However, here's why this matters for your immediate strategy. If the broader stock market suffers a significant correction, Bitcoin often sells off initially due to a liquidity crisis. In the liquidity crisis, investors sell whatever they can, not just what they want to sell. Therefore, the $78,000 level is a psychological line in the sand. If we can hold this level as support, it validates the safe haven thesis. If we fail to hold it, the market will likely view this recent move as a risk-on rally that ran out of steam. We are seeing the 30-day moving average for exchange inflows hit a 3-year low. This is a bullish signal on the surface because it means fewer people are sending Bitcoin to exchanges to sell. However, we must look deeper at the over-the-counter desk data. The volume on over-the-counter desks has spiked by 20% in the last week alone. This means that large transactions are happening off the public order books. Whales are trading directly with each other to avoid moving the price and alerting the retail market. This is classic distribution behavior disguised as accumulation. If this data is helping you stay ahead of the crowd, feel free to join our inner circle by subscribing to the channel for daily updates. Let us pivot to the macroeconomic environment because you cannot trade Bitcoin in a vacuum. The Federal Reserve is currently walking a tightrope regarding interest rates and inflation control. When interest rates remain high, the cost of borrowing capital becomes expensive. This drains liquidity from the financial system, and liquidity is the fuel that Bitcoin needs to sustain a parabolic run. We are seeing the global money supply contract on a year-over-year basis. Historically, every time the global money supply contracts, risk assets struggle to maintain their highs. The recovery to $78,000 is fighting against this macroeconomic headwind. It is a testament to the strength of Bitcoin that it has risen despite these conditions. However, we must ask ourselves how long this divergence can last before gravity takes over. The bond market is flashing warning signals that a recession may be on the horizon. If a recession hits, the initial reaction for all assets, including Bitcoin, is typically a sharp decline. This is why I am cautious about calling this a pure safe haven play right now. A true safe haven protects your capital during the crash, but Bitcoin often acts as a leading indicator for the crash. Now let us examine the behavior of the exchange-traded funds. The introduction of spot exchange-traded funds has fundamentally changed the market structure. We have seen net inflows of over $400 million in the past week. On the surface, this looks incredibly bullish and supports the price ride. But the nuance lies in the type of orders these funds are using to acquire the asset. They are using passive limit orders to absorb selling pressure rather than aggressive market orders to drive the price up. This creates a floor for the price, but it does not necessarily create the momentum needed to break resistance. The institutions running these funds are patient and price sensitive. They're not chasing candles like retail traders who are afraid of missing out. They are happy to let the price come to them. This is why we are seeing the price chop around the $78,000 mark instead of blasting through it. The reality is that the institutions are building a position for the next 5 years, not the next 5 days. If you are a short-term trader, you need to be careful not to get chopped up in this accumulation range. Understanding the difference between passive accumulation and aggressive buying is what separates the pros from the amateurs. If you appreciate us breaking down these complex institutional behaviors, make sure to like this video so we know to keep producing this type of content. We also need to look at the miner capitulation cycle. Since the last halving event, miners have been under immense financial pressure. The cost to produce one Bitcoin has risen significantly, squeezing profit margins. At $78,000, many miners are finally back in the green. We are observing a slight increase in miner outflows to exchanges. This suggests that miners are using this recovery to sell inventory and cover their operational costs. This selling pressure acts as a natural dampener on the price action. It is not a massive dump, but it is a consistent supply of Bitcoin hitting the market. This supply must be absorbed by new buyers for the price to maintain its current level. If the demand from the exchange-traded funds slows down even slightly, the miner selling could push the price back down. Another metric that is flashing a warning sign is the short-term holder realized price. The short-term holder realized price is the average price at which coins moved in the last 155 days. Currently, the spot price is well above the short-term holder realized price. This means that almost everyone who bought Bitcoin in the last 5 months is currently in profit. When short-term holders are in massive profit, the temptation to take profits increases. We are seeing the profit-taking metrics spike on on-chain data platforms. This is healthy in a bull market, but it creates resistance. The market needs to churn through this profit-taking before it can move higher. If the profit-taking becomes too aggressive, it can trigger a cascade of liquidations in the futures market. Speaking of the futures market, the open interest is at a near record high. Open interest represents the total number of outstanding derivative contracts. When open interest is this high, it means there's a massive amount of leverage in the system. High leverage usually leads to a flush event, where the market moves violently to liquidate over-leveraged traders. The funding rates are currently positive, meaning long positions are paying short positions. This indicates that the majority of the market is betting on the price going up. When the crowd is this unanimous, the market often likes to cause maximum pain by moving in the opposite direction. A flush down to the low $70,000 region would clear out this excess leverage. Such a move would be healthy for the long-term trend, but devastating for late entrants. Let us discuss the geopolitical aspect of the safe haven narrative. In times of geopolitical uncertainty, capital controls often become tighter. Bitcoin offers a way to bypass these capital controls and move value across borders. We are seeing increased usage of Bitcoin in regions with unstable currencies. This fundamental utility is what provides the long-term floor for the price. However, this utility does not prevent short-term price volatility. The $78,000 level is precarious because it is right below the psychological barrier of $80,000. $80,000 is a round number that will attract a lot of media attention. If we break $80,000, we enter a phase of price discovery where there is no historical resistance. But to get there, we need a fresh injection of liquidity. We need retail investors to return to the market in force. Currently, retail interest as measured by search trends and app downloads is still relatively low. This rally has been driven by institutions and existing crypto natives. Without a new wave of retail capital, the upside may be capped in the short term. So, is Bitcoin a safe haven or a risk asset at $78,000? The answer is that it is currently acting as a hybrid. It is acting as a safe haven against currency debasement, but a risk asset regarding liquidity conditions. This duality creates a complex trading environment. You cannot simply buy and hold blindly without watching the key levels. The playbook for the coming weeks requires patience and discipline. You need to watch the $76,000 level as your invalidation point. If the price closes a daily candle below $76,000, the bullish structure is compromised. That would indicate that the breakout was a fake out and lower prices are coming. On the other hand, if we can consolidate above $78,000 for another week, the probability of a move to $85,000 increases. Do not leverage into this resistance. Let the market prove itself to you first. Wait for a confirmed breakout and a retest before committing significant capital. The risk-to-reward ratio is not favorable for new long positions right here. It is better to buy higher with confirmation than to buy here and get caught in a bull trap. Preserving your capital is the most important rule of this game. The market will always be there, but your capital might not be if you are reckless. Stay focused on the data and ignore the emotional hype on social media. Please remember that I am not a financial advisor. Everything discussed in this video is for educational and informational purposes only. You must do your own due diligence before making any investment decisions.